Imagine building like a multi-million-dollar extreme obstacle course.
Oh boy, okay.
Yeah, you've got the land secured, you've got these massive zip lines suspended over ravines, trenches filled with, thick mud pits.
Sounds messy.
Very. And giant inflatable structures people have to just hurl themselves across, maybe even throw in a little fire just for ambiance.
Naturally.
Right. So you have your investors lined up, you've got the waiver forms printed out, but I mean, before you can open your doors, you need insurance.
You definitely do.
So you call up a standard commercial insurance company, you explain this glorious mud-soaked vision, and they essentially just laugh in your face.
They politely decline.
Yeah, politely decline. They say your business is outside their appetite and flat out reject you. And you can't operate legally without coverage, right? You certainly can't satisfy your investors. So, what do? Do you just drain the mud pits and open a really boring petting zoo?
I mean, that is the exact moment where a lot of founders just panic. Because in the standard insurance world, a business profile like that is genuinely terrifying.
Right.
But you don't actually have to abandon the core concept of the business. You just have to know how the broader insurance ecosystem actually functions behind the scenes.
Which brings us to exactly why we're here. Welcome to this deep dive for the Insurance Study Companion. Our mission today is figuring out exactly how the weird, the dangerous, and the completely unprecedented get insured.
Yeah, it's fascinating stuff.
We are unpacking what is often called the market of last resort for the commercial world, the excess and surplus insurer, or, the E&S market.
Yep, E&S.
And whether you're a CPCU student grinding through courses on insurance operations or business law, or maybe an established professional, or just someone who's insanely curious about how innovation happens, this conversation is going to totally reframe how you view risk.
Because at the end of the day, nothing new can happen in the economy without someone willing to put a financial guarantee behind it. So, I mean, the foundation of this whole system really starts with drawing a clear dividing line between what we'd call normal risks and extraordinary risks. You really have to understand what a standard insurance company does to get why the E&S market even needs to exist.
Okay, so let's start with the standard ones then.
Right. So we refer to standard companies as admitted insurers.
Admitted.
Yeah.
Mm-hmm.
They're licensed by the state, and they thrive on, predictable, ordinary risks. They want millions of data points. Think standard auto policies, homeowners insurance, your basic Main Street retail store.
So they basically need the law of large numbers to make their whole financial model work.
Exactly.
Like a Main Street bakery is easy to price because there are, tens of thousands of bakeries. We know exactly how often they catch fire.
Or how often someone slips on a wet floor.
All right.
But your extreme mud pit obstacle course with the flaming hoops...
The flaming hoops are essential, yeah.
That does not fit into those actuarial tables at all. It is an extraordinary exposure. And that is where our target for today comes in. An excess and surplus insurer provides coverage for those high-risk, unusual, or just really difficult to insure exposures that the admitted, licensed insurers are just completely unwilling or unable to touch.
They're essentially the safety valve for the whole commercial economy. When the standard market looks at a risk and says no, the E&S market is structured to figure out a way to say yes. For the right price, obviously.
For a price, yeah.
So let's unpack this a bit, because the study notes use this two hospitals analogy, which I think does a really great job explaining the routing of risk here.
That's a great analogy.
Yeah, they compare a standard admitted insurer to a general hospital. Like a general hospital is fantastic for common illnesses, right? You break your arm, you get strep throat, you go to the general hospital. They have standard intake procedures, standard billing. They see that exact same broken arm 100 times a day.
Right, it's routine.
So if the admitted market is the general hospital, I would assume the E&S market is like the emergency room? Or is it something else entirely?
I'd say E&S is actually the specialist hospital.
Oh, a specialist hospital.
Yeah, because a general hospital will look at a really complex, rare disease and say, look, we don't have the specific expertise or equipment to treat this safely. You need the research hospital.
Right.
So in the business world, those rare diseases are risks like fireworks manufacturers or the commercial cannabis industry in states where it's permitted, or highly complex cyber liability exposures.
That's just too volatile.
Exactly. The standard admitted market just doesn't have the off-the-shelf products to treat those risks. And a really handy memory trick for the students listening, E&S stands for excess and surplus, but you can also just think of it as handling extraordinary and specialized risks.
Extraordinary and specialized. I like that. I do want to dig into the terminology here, though, because if you're an insurance broker pitching an E&S policy to a new client, you're going to run into a massive perception problem.
Oh, absolutely.
Because the official term for an E&S insurer is a non-admitted carrier.
And I mean, if I'm a business owner and my broker tells me they finally found coverage, but it's with a quote-unquote non-admitted company, my brain immediately translates that to illegal or unregulated.
Right, like some offshore shadow operation or something.
Exactly. So how do we explain the reality of non-admitted to, say, a skeptical client or a really strict board of directors?
It's a totally understandable reflex for a client to hear non-admitted and just panic and think unregulated. But it is a massive misconception that you have to clear up immediately.
So they aren't illegal.
No, not at all. Being a non-admitted insurer has absolutely nothing to do with being sketchy. It simply means they are not licensed in the standard traditional way by that specific state's insurance department. But they are completely legal, they are state approved, and they are officially eligible to write surplus lines business in that state.
So the state is fully aware of them? They aren't, like, flying under the regulatory radar? No. In fact, to even operate as a non-admitted carrier, they have to meet really strict financial requirements just to be placed on a state's official approved list.
Oh, wow. Okay.
Yeah, regulators actively review their balance sheets. The term not admitted strictly reflects their regulatory status regarding how they file their rates and forms. It basically gives them freedom from standard filings, which we'll get into, but it is a fully legitimate, highly sophisticated financial market.
That makes the whole specialist hospital concept much easier to swallow, I think. But this brings us to the actual mechanism of how this works, like the how and the why.
Right.
Because if an admitted insurer runs for the hills when they see a fireworks factory because it's just too volatile, how is the E&S underwriter able to just calmly sit there, do the math, and take on that literally explosive risk? What is their secret sauce?
The secret sauce is underwriting and pricing flexibility.
Flexibility.
Yeah. So let's look at the standard admitted market again. They are heavily regulated in terms of their actual products. If an admitted insurer wants to change their rates or alter the wording of a policy, they usually have to submit these massive filings to the state insurance department and wait months for approval. It is very rigid.
Okay.
Think of it like buying a suit off the rack.
Sure.
You can maybe hem the pants, but the core structure of the suit is already determined. You can't just change the fabric.
And a standard business just has to, fit into that off-the-rack suit.
Right. But E&S insurers, because they're dealing with these extraordinary risks, they're granted freedom from those rate and form filings by the state.
So they don't have to wait months for approval.
Exactly. Because they are non-admitted, they don't rely on those rigid rating manuals. They have the immense freedom to evaluate every single submission individually.
Wow.
Yeah, they employ highly specialized underwriters who can look at a totally bizarre risk, break it down to its component parts, and create a customized premium model from scratch.
So they're basically making a bespoke suit, like sewing it together piece by piece based on the exact measurements of the client's weird business model.
That's exactly it. And that bespoke suit is what we call manuscript policy wording.
Manuscript, like handwritten.
Right. They are not pulling a pre-printed form off a shelf. The underwriter is drafting a highly customized legal document. It's a coverage form that specifically addresses the unique exposures, the exclusions, and definitions for that one specific client.
Okay, but how does that actually work in practice when you have, zero historical data? Because the sources mention an autonomous drone delivery startup, right?
Right, yeah.
So you're starting a company to drop off packages in suburban neighborhoods using AI-piloted drones. The standard admitted market has absolutely no manual for this.
None?
The tech changes every 6 months. The liability is completely uncertain. If a drone drops a package on a moving car, who is liable? Is it the hardware manufacturer, the software developer, the client?
It's a legal nightmare.
Exactly. With zero data, how does the E&S underwriter actually price that manuscript policy without just guessing and hoping they don't go bankrupt?
Well, that is where the real art and science of E&S underwriting comes in. When there's no direct historical data for a new tech, like autonomous drones, underwriters rely on proxy data and theoretical modeling.
Proxy data.
Yeah, so they might pull loss data from, say, manned commercial aviation.
Yeah.
Right? And then combine it with data from the commercial trucking industry for the logistics side of things, and then factor in software failure rates from the autonomous vehicle sector.
Oh, I see. They're essentially triangulating the risk based on adjacent industries.
Precisely. They're building a mosaic of risk. And they also rely heavily on concepts like maximum probable loss.
Maximum probable loss.
Yeah, they literally sit down and model out the absolute worst-case scenario. Like, what happens if a drone causes a massive multi-car pileup on a major highway? Yeah, they calculate the potential financial devastation of that exact event and price the premium to ensure the insurer is adequately compensated for taking on that massive unknown volatility.
And because they have that manuscript flexibility you talked about, they can build a policy that addresses all those different facets.
Exactly.
They can create a customized package that weaves together aviation liability, product liability for the drone itself, cyber liability in case the navigation gets hacked, and standard property damage. They merge it all into one document.
It's incredible.
But the startup itself can't just, call up an E&S underwriter and buy this, right? There's a very specific gatekeeper involved here.
Yes. What's fascinating here is that the routing of the business is highly regulated. You cannot access this specialist hospital without a referral. A standard retail insurance agent cannot place business directly with an E&S carrier.
Okay, so who do they call?
They have to use a specially licensed professional called a surplus lines broker.
Okay, so the surplus lines broker is the intermediary. Why does the state mandate that extra layer, though? What is the broker actually doing?
Well, the surplus lines broker is the matchmaker, but they also serve a vital regulatory function. They actually have to formally document that the standard admitted market has rejected this risk.
So you can't just skip the line.
Right. Usually this requires proving that they receive multiple declinations from standard carriers. And this proves to the state that the business genuinely belongs in the surplus lines market, and you aren't just trying to bypass standard regulations for fun.
That makes sense.
Yeah. And once that's documented, the broker, who has to speak the highly technical language of both the crazy startup and the specialized underwriter, they negotiate the actual terms of that bespoke manuscript policy.
If you step back and look at the macro picture, the E&S market is quite literally the engine of economic innovation.
No, 100%.
Because without that surplus lines broker and that underwriter's ability to build that customized policy, that drone startup is dead in the water.
They can't do anything.
They can't get financing because venture capital firms obviously demand risk protection. They can't sign contracts with vendors. The admitted market says no to the unknown, but the E&S market figures out the mathematical proxy data to say yes for a price.
It really expands the overall capacity of the insurance industry to absorb shocks. But, that raises a really interesting operational challenge.
Which is?
Well, if an E&S carrier is constantly writing manuscript policies for highly volatile, zero-data risks, their own balance sheet is constantly under immense threat. Like, one massive, unforeseen technological disaster could wipe out the entire premium pool they collected.
Right. So how do they survive that?
The answer is reinsurance.
Reinsurance. So the insurance for insurance companies.
Correct. E&S carriers are massive buyers of reinsurance. Because they take on risks that the standard market won't touch, they have to lay off or syndicate a large portion of that risk to global reinsurers.
So they share the load.
Yeah. By transferring chunks of that extreme volatility to the global capital markets, the E&S carrier actually protects its own solvency. It allows them to keep underwriting those wild, unprecedented risks without risking bankruptcy on every single policy.
But the threat of bankruptcy is exactly why the regulatory framework is set up the way it is, isn't it?
Yes, it is.
Because, if E&S insurers offer all this amazing flexibility, these custom-tailored policies, and they're basically the heroes of innovation, it begs a very obvious question. Why doesn't every business use them?
Right, why wouldn't you?
Why can't a standard Main Street bakery just decide, they want a cool, customized E&S policy instead of their boring standard policy?
Well, because that incredible freedom of rate and form comes with a massive foundational regulatory trade-off. This is something buyers really must understand. And honestly, if you're a CPCU student listening right now, this trade-off is the underlying logic behind almost every E&S exam trap you're going to face.
Okay, lay it on us.
It all centers around what happens when an insurance company fails.
So what does this whole mean? Let's talk about the safety net, or I guess in this case, the lack of one.
The lack of one, yeah.
Because in the standard admitted market, you have a financial backstop. If a standard insurer goes bankrupt and just runs out of money to pay claims, the state steps in.
Right.
Every state operates a guarantee fund, which is essentially this state-administered pool of money funded by all the admitted carriers. It steps in to pay outstanding claims, so the consumer, like our Main Street bakery, isn't left holding the bag.
It's kind of similar in concept to the FDIC protecting your bank account, right?
Exactly. It's a huge safety net. But to get the freedom to write manuscript policies and bypass state rate approvals, the E&S market operates completely outside of that safety net.
Wait, really?
Yeah. If an E&S insurer goes bankrupt, there is usually no guarantee fund protection for the policyholder.
Wow. That is a staggering reality. So if my extreme mud pit obstacle course is insured by an E&S carrier, and that carrier becomes insolvent, and then a participant gets severely injured on my zip line, I am entirely on the hook.
You are. The state guarantee fund is not coming to rescue me or pay that claim.
Nope. You assume the credit risk of the insurer. The regulatory philosophy here is that if you are forced into the E&S market, you're typically a much more sophisticated commercial buyer. You, alongside your specialized surplus lines broker, are expected to thoroughly evaluate the financial strength and credit rating of that E&S insurer before you sign the contract.
Wow, okay.
You are explicitly trading the safety net of the state guarantee fund for the flexibility to just get your weird risk insured in the first place.
And this is exactly where exam writers for the CPCU love to lay traps, right?
Right.
Because students often memorize the term non-admitted and just assume that means the Wild West.
Oh, all the time.
They assume that because there is no guarantee fund and no rate filing, these E&S carriers just operate in a void without any regulatory oversight whatsoever.
And that is trap number one. Flexibility does not mean anarchy. E&S insurers are heavily regulated. They're just regulated differently.
Differently. Okay.
While the state doesn't micromanage what they charge or the specific words in their policies, they fiercely monitor their financial solvency.
But how does that coordination actually happen across 50 different states with 50 different insurance departments? Because that sounds chaotic.
It's actually largely coordinated through the NAIC.
The National Association of Insurance Commissioners.
Right. The NAIC helps set model laws and financial benchmarks. They maintain massive databases that track the capital and surplus levels of these non-admitted carriers.
So they're keeping a very close eye on the money.
Extremely close. The states actually require these carriers to hold significant capital reserves, often way higher minimums than standard carriers, precisely because the risks are so volatile and there is no guarantee fund backstop.
Right.
The regulators want to ensure that if an E&S carrier is writing a policy for a fireworks factory, they actually have the millions of dollars in liquid capital required to pay the claim if the factory detonates.
So the regulatory focus basically shifts from consumer protection on the front end, like proving the wording of a policy, to intense financial surveillance on the back end.
That is a great way to summarize it. If we connect this to the bigger picture, the state surplus lines, laws, dictate the rules of engagement. They manage licensing the brokers, ensuring the standard market declined the risk first, and monitoring the financial health of the carriers.
Yeah.
This delicate balance of freedom versus financial protection is the absolute cornerstone of the U.S. commercial insurance framework.
It's an incredibly elegant system when you really break it down. Standard risk flows one way, extraordinary risk flows another, and capital markets through reinsurance back up the most volatile elements.
Right.
It completely reframes how you look at the business world.
It really does.
So if we pull all these threads together into a core takeaway for today's deep dive, the rule of thumb is quite clear. If you are dealing with standard risk predictable, common, with decades of actuarial data that belongs in the admitted market.
The general hospital.
Right. They have the off-the-rack policies and the protection of the guarantee fund.
Yeah.
But if you are dealing with hard-to-place, unusual, emerging, or high-hazard risk, that must flow to the E&S market, the surplus lines market.
The specialist hospital.
Exactly.
Right.
They build the bespoke manuscript policies, they rely on proxy data to price the unknown, and you trade the guarantee fund safety net for the ability to innovate.
Standard to admitted. Extraordinary to E&S. Understanding that bifurcation is just the absolute key to understanding commercial insurance operations.
Here's where it gets really interesting, though, and I want to leave you with a final thought to mull over as you digest these concepts. We just established that E&S insurers are the pioneers, right?
Right.
They write the very first policies for emerging, unprecedented risks. Years ago, they wrote the first cyber liability policies when no one even understood the internet. Today, they're writing the first autonomous drone policies.
Yeah.
So does that mean the E&S market is actually the R&D testing laboratory for the future of the entire industry?
Oh, that's a great point.
Because think about the life cycle of risk. As these E&S carriers gather years and years of real-world loss data on these wild, unprecedented exposures, the unknown slowly becomes predictable.
The math solidifies.
Exactly. The math solidifies. So, will today's E&S extraordinary policies eventually become tomorrow's standard admitted market policies? When drone deliveries are just as mundane as the Postal Service, will the General Hospital start treating them?
I mean, it's the natural evolution of risk. What requires a bespoke, heavily negotiated manuscript policy today might just be a standard commercial endorsement that you buy off the shelf 20 years from now.
Yeah.
The E&S market is charting the territory so the admitted market can eventually move in.
Which makes you wonder what the surplus lines brokers will be pitching in 50 years.
Yeah.
Teleportation liability, Mars colony property damage.
I wouldn't rule it out.
The risks will change, but the mechanism to cover them will remain exactly the same.
Well, we want to thank you for joining us on this deep dive. Whether you are taking your CPCU exams this week or just navigating the commercial market, keep looking closely at the risks around you.
Keep questioning how the financial mechanisms actually operate behind the scenes.
And remember, the next time you see a massive, muddy, flaming obstacle course, there is a highly specialized underwriter out there who modeled the maximum probable loss and made that whole thing possible. Keep studying, and we'll catch you on the next deep dive.